How can a retail investor put their money to work in venture capital? That's what I want to show you today. Of course, the first thing that you need to look at is, should you invest in venture capital? And that is an answer that is unique for every person and every investor. So this is not a recommendation to go put your money into venture capital. You need to seek advice from your advisor about that and get an understanding of if it makes sense for your situation. And also, I'm going to show you a specific fund that's available today, but this is in no way a stamp of approval on this fund or suggesting that you should put money to work in this fund. But first, what is venture capital? And it really falls under the umbrella of private equity. And we know that private equity, at least growth and buyout private equity, historically generates a little bit better return than the S&P 500 does, also with a little bit less volatility. Venture capital is really just the earlier stage private equity. So you can really look at it in three different segments. So the funding round, or the very early funding of a company, the seed round, would be a Series A to B early stage. And that is the earliest funding of a business. So typically, they're not making money. It's just an investment in growth or technology. Therefore, venture capital is one of the highest risk, also the highest return asset classes available. Now, if you invest in one venture capital fund, say one general partner, they may own 15 or 20 different businesses. Typically, the majority of, especially when we're talking about seed rounds and early stage, the majority of those investments made amount to losses. But if they have 1 or 2 out of 10 that get a 10x or 20x return, that's generally what keeps a venture capital fund afloat and generates a return to the investors. But there's nothing to say that as an investor, if you go into one general partner or one fund, that you couldn't lose 30 or 40 or 50% in a year because they don't have that one particular investment that generates that high multiple return. But and seed is going to be your highest risk. And then you have early stage, which is medium risk, and that's relative to venture capital. And the whole scheme of asset classes available to an investor, these are all going to be high risk. And then you have late stage, or kind of almost getting into the growth private equity stage, where hopefully we have some profitability by then. And in terms of venture capital, it's slightly lower risk. Why is venture capital appealing? And this is kind of also why private equity is appealing right now. On the bottom left here, the median market cap for IPOs has grown significantly in the last 20 years. So that means that prior to going public, there is a lot more growth happening in these businesses, thus creating these very high valuations at the IPO. So if you see a lower number or an even number of companies going public with higher valuations, that just means that there's more happening in the private markets, which is exactly what's happening right now. And we also are seeing an increase in venture capital backed IPOs. So just a lot of activity in both venture and private equity. Now, the high return profile of venture capital is illustrated quite well here across multiple time periods. Wouldn't pay too much attention to the 1 year, but looking at the 5, the 10, and the 25-year return, we have the blue is venture capital, which consistently outperforms the orange, which is private equity, by just a couple points. But when you compare it to the Russell 2000 in dark blue, we can see that through every time period, both venture capital and private equity have outperformed. Now, historically, or at least in the past, venture capital was really not accessible at all to retail investors. Now there are some funds like the one that I'm going to show you right now that are accessible to qualified purchasers. So we're talking about investors that have 5 million or more in investable assets, typically $250,000 minimums with very limited liquidity. And this fund is going to be an example of that. This is actually from Crescent Partners. And they're doing an illustration on this slide of more looking at, from a 30,000-foot view, alternative investment asset classes over here on the right versus your actively managed funds in publicly traded segments of the market. So I did a video that you could certainly watch. What are high net worth investors or institutions investing in? And they're very concentrated in these asset classes, the alternative asset strategies. So hedge funds, absolute return, the top 5%, averaging 6%. Global real estate, 15.5. Global private equity, 21.2. And of course, the most aggressive, highest risk, venture capital, 29.4. But then when you compare that to even the U.S. small cap, the top 5% of fund managers averaging 3%. And then if you go over to large cap, it's about 2%. Large cap value, 1.9. So you can see these alternative asset classes far outperform the public equity strategies. Now, there's some big trade-offs there. Every fund is going to be different. And this is why, this is not a suggestion to invest in this particular fund or in private equity or in venture capital at all. It's something that is unique to each person, and you really need to seek advice from your advisor or your CFP. But this is a fund that we are using for our clients that do qualify. And instead of it being an investment into one venture capital firm or one general partner, which again is going to limit your diversification, where if they don't have that one or two winning investments in that year, can significantly impact your overall return in a very negative way. An investment in this particular fund is allocating across 10 of the leading venture capital firms in the United States. And furthermore, each of these firms may have 2 or 3 different funds, each fund focusing on a different stage of venture capital and in a different sector of the market, and also in a different geography, whether it's global or the US. So what this accomplishes is if you're a retail investor, a qualified purchaser, 5 million or more investable assets, and you just want to allocate maybe 5 or 6% of your total portfolio to venture capital, you may only have room for 1 or 2 funds. This would be a way to get a really well diversified portfolio of venture capital that hopefully is going to generate that higher return than private equity, the higher return than real estate, the increased return over public equity strategies, but keep you spread out so you're not overly concentrated into any one firm or any one fund that may have a bad year. So if you'd like to understand more about this specific fund or talk about your situation and if venture capital or private equity or really any of the alternative asset classes might make sense for you, feel free to reach out for us, but I hope this was at least informative for you. Thank you. Have a great day.